Meet Dennis. Dennis has been trading for about 2 years. In market terms, that means he's basically a toddler who just learned how to open a brokerage app. His portfolio is up 14% year to date. He caught a lucky break on a random crypto token with a dog logo, and now his confidence is through the roof. Dennis truly believes he's cracked the code. His daily routine includes binge-watching The Wolf of Wall Street, explaining next-gen AI stocks to strangers at bars, and calling himself a long-term investor while checking his portfolio every 6 minutes. So, naturally, Dennis decides it's time to level up. He calls his broker, exaggerates his net worth just a little, and gets approved for options trading. Fast forward 3 months. Dennis is now fully loaded on out-of-the-money Tesla calls. His trading strategy? Buy whatever's moving and pray it keeps moving. His risk management? Vibes. His exit plan? There is none. Meanwhile, his partner has a simple question. Why did $13,000 disappear from our savings account? Another 3 months pass. The Federal Reserve raises rates, markets wobble, volatility spikes. Dennis's portfolio is now down 68%, and his partner has developed a new hobby, searching how to divorce someone who calls himself a market genius. Which brings us to today's question. Why do the dumbest investors seem to win? Enter the Kruger Effect, Finance Edition. It explains why inexperienced traders think they're the next Warren Buffett, why experienced investors constantly doubt themselves, and why Dennis believes market manipulation is the only reason his options expired worthless. Since 2020, you could have thrown money at almost anything with a ticker symbol and made money. And if you were sitting at the peak of confidence with minimal knowledge, right where Dennis was, you probably crushed the S&P 500. Meanwhile, traditional investors were busy talking about cash flows, valuation multiples, and fundamentals, while momentum traders were buying companies trading at 600 times earnings, riding trends that make less sense than pineapple on pizza, and aggressively convincing anyone with Wi-Fi to buy in. If you zoom out even further, the reason becomes obvious. We've been living in one of the greatest bull markets in history. 17 years, over 700% returns. Since 2009, the market has basically been on a non-stop bender. In that environment, high risk, high beta, borderline irrational strategies don't just survive, they thrive. But like all legendary benders, this one eventually ends. So how do you prepare? Option 1. Sit on cash like Buffett. Be patient. Accept boring returns. But let's be honest, that's not exciting. Which leads to option 2. Go all in. Ignore risk, and when things fall apart, blame someone else. The Fed, politicians, market makers, anyone, as long as it's not you. Because taking responsibility for losses is not part of Dennis's strategy. And that brings us back to the real answer. Why do the dumbest investors win? Because retail investors love volatility. They chase high beta stocks. Let's break that down quickly. Beta measures how much a stock moves compared to the overall market. If a stock has a beta of 1.3, it means it's 30% more volatile than the market. So, when the market goes up 2%, that stock might jump 2.6%. But when the market drops 2%, it falls just as hard. In a bull market, a high beta portfolio makes Dennis feel like the next George Soros. In a bear market, that same portfolio turns him into a cautionary tale on Reddit. When markets are rising, Dennis is booking expensive dinners to celebrate his brilliance. When markets fall, Dennis is checking job listings and blaming Jerome Powell. So next time your friend brags about their latest 10x trade, remember this: everyone's a genius in a bull market.